Hi everyone, once again thank you for joining us for our live webinar on Smart Trader Essentials, Mastering Forex Basics, Trend Patterns and Market Momentum. This is Phil Gunn. I'm a Senior Sales Manager with Philip Nova. In today's webinar, we'll be discussing Forex trading on the MT5 platform. Before we begin, I would like to do a sound check. If you can hear me, just type yes in the question box. During the webinar, if you have any questions, do type them down in the question box and I'll be addressing them during the Q&A session at the end of the webinar. Okay, good. Since everyone can hear me clearly, let's begin tonight's webinar. My name is Phil Gunn, the speaker for this webinar, and I've been with Philip Nova for 15 years now, since 2008. I hold a dual license in futures, stocks, and I'm a account manager to help clients trading in futures and Forex, as well as shares with understanding the product and market by providing coaching and economic information to make proper trading decisions. Understanding Forex fundamentals is crucial for mastering the Forex because it provides traders with a comprehensive view of the economic, political, that influence currency values. The Forex market is highly sensitive to a wide range of variables, and a solid grasp of fundamentals can help you make informed decisions and manage risk effectively. Equally important is the skill to grasp the technical aspect of identifying trend patterns and evaluating price strength. Recently, we have seen a new change in the momentum of the Forex market. That is the emerging trend of the USD weakness. I will share some basic concepts of observing price strength through the candlesticks using charts. We'll first touch on understanding the mechanisms of Forex in the first half of the webinar. Throughout the webinar, you may have questions. Just feel free to post them in the question box. My facilitator will arrange them and let me know, and I'll answer them at the end of the session. This webinar itself will also be put up later on YouTube after today for you to revisit if you wish to do so. Okay, let's get right to it. Before we start, just a disclaimer that materials provided here is for general information and does not constitute a recommendation or solicitation to trade. Right, the agenda for today. We'll start with the introduction to Forex trading, a brief recap for beginners on what Forex trading is about. We'll mention the key features of the Forex contracts to have a better understanding what you're dealing with. We also go through quickly some Forex mechanics such as the calculations when you enter a Forex trade and how to manage the carrying out of such trades. On the second half of the webinar, we'll be going to basic technical analysis such as trend patterns and candlestick charts. I'll be sharing with you the information that I use when I do analysis on the technical aspect of chart. Next, we'll be looking into basic fundamental analysis, discussing on factors that actually affect currency prices that you should look out for, as well as important economic indicators. Lastly, when we have time, we'll be doing the quick walkthrough of the MT5 platforms and what are the tools in the MT5 platform that may be useful to you when making trade decisions. All right, let's get started. So, the Forex market is a very huge market. The average traded value is around 2 billion daily. It's traded over the counter. What that means is all transactions are conducted electronically and not over the exchange. The counterparty are the banks spread across various financial institutions across almost every time zone. There's a gap when the US banks are offline and Asia takes over, say around 4 a.m. to 6 a.m. Liquidity at this hour is lowest and should be avoided. Since there's no centralized exchange, it is not transparent and orders are filled according to the prices that the banks provide. Forex is always conducted in pairs. It is basically the exchange rate between two currencies. For example, euro-dollar. You are speculating on the strength of the euro-dollar against US dollars. A view that the euro will strengthen will result in the actual value of this rate to increase. Let's take the analogy of exchanging money and a money changer. Say euro-dollar rate is at 1.09 just for example. This means that with 1 euro-dollar, you can change it for 1.09 US dollars. If you go to the money changer with 10,000 US dollars, and change it to euros at this rate, you will get 9,174 euros. Later on, in the future, when the rate increases from 1.09 to 1.11, you decide to change it back to the US dollars. Now, when you change the 9,174 euros back to US dollars, you will get $10,183. Hence, you have made a profit in US dollars from this exchange of currency. So, instead of going to the money changer, using Forex contracts, you can avoid using physical money and speculate on this exchange rate. You can simply just make an online trade to buy a contract size of 10,000 instead, at the exchange rate of 1.09. Subsequently, when the figure rises to 1.11, you can close contract and make a profit when it rises. Hence, you buy at a lower rate and sell at a higher rate when the exchange rate rises. Compared to the money changers, the spread of Forex is very tight, as low as 0.6 pip spread, compared to money changers, which can be 50 pips or even more. Also, you do not have to come on with the full value of the money required for this exchange, as Forex has a leverage mechanism which allows only to put a margin for the amount of money that you wish to change. So that's the basic concept for Forex trading. We'll have a quick run through on what are the things that will actually that you need to consider for trading in Forex. First of all, the economic indicators. Economic indicators such as GDP, employment rates, inflation, interest rates, all play a significant role in determining a country's economic health. Changes in these indicators can have a direct impact on nation's currency value. Traders who understand and analyze these indicators can better anticipate the currency movements. Also, interest rates and central banks' policies are important, as central banks influence currency values by setting interest rates and implementing monetary policies. Traders need to pay attention and stay informed about central banks' decisions, their statements, and policy changes, as this can impact the currency values. Higher interest rates, for example, can attract foreign capital and strengthen a currency. Take, for example, the Federal Reserve has been leading the way in raising interest rates, having a tightening of monetary policies as opposed to a loose monetary policy. This results in the strengthening of the dollar-yen as BOJ, the Bank of Japan, maintain their negative interest rates. Next, political stability and economic performance. These are very important indicators that intertwine. Political events such as elections, government policies can have a profound impact on a country's economy and its currency. Traders must be aware of geopolitical tensions and also understand how politically stable or unstable the country is that can affect currency markets. Lastly, risk management. This is something that is often not discussed enough. Fundamental analysis helps traders assess and manage risk. By understanding the factors that drive currency movements, traders can implement risk management strategies to protect their investments. This will include setting up stop-loss orders, diversifying portfolios, and adjusting their position sizes based on market conditions. In conclusion, mastering the Forex markets requires a holistic understanding of these fundamental factors that influence currency. Fundamental analysis complements with technical analysis, helps traders to make informed decisions based on a comprehensive view of the market. It provides a foundation for developing an effective trading strategy and also managing the risk involved. All right, we'll quickly move on to the key characteristics of the Forex contracts. Firstly, the Forex market is a bidirectional market. In the earlier example, you view that the euro will strengthen, so you buy the rate first. However, you can also think that the rate will be dropping, and you can sell the rate first and then buy back later at a lower rate. This allows you to trade both directions of the market effectively. With Daylight savings, you can trade Forex 24 hours starting from Monday 5 a.m. Singapore time to Saturday 5 a.m. There is no trading during the weekends as the banks are closed. Hence, you can trade on your mobile through the app or at night when you have time to monitor on your PC. There are various contract sizes available to adjust to the risk exposure according to your requirements. In the earlier example, we are talking about 10,000 contract size. This is the mini contract size. Per pip movement is $1 movement. And a big movement of 100 pips per day will be about $100 movement, US dollars movement in the market. If you think that this size is too big for you, you can still scale it down to the micro size of only 1,000 or 1K per contract. This is the micro size contract, which is 1/10 the size of a 10,000 mini size contract. So in this case of a micro contract, 100 pips movement will only be 10 US dollars. I would say that this is actually a reasonable risk or movement per day that anyone can go for as a beginner. So there's always a comfortable size for every trader, and new traders can start with the micro size first to familiarize and slowly move on to mini sizes or the regular lot sizes. You can do this with the platform Amplify platform that we have as our trading platform, and I'll be discussing more on this later on. Subsequently, you can decide to choose a reasonable size once you have developed a trading plan. This can be in multiples of the micro, mini size, or regular size. So it not be a full figure. It can be 4,000 contract size, 17,000 or 113,000 or any denominations of 1,000. So all the margin required is in US dollars. The margin required is 5% of the contract value. For example, a 10,000 euro dollar contract, 5% of it will be 500 euro dollars. This will mean that you require 500 euros to be the margin, which is about 546 US dollars. So with 546 US dollars in account, you can start with mini contract sizes and do one mini lot size. Now, if you wish to do a micro lot size, you only need to have 54 US dollars in the account to start trading. Now, this is actually a leverage of 20 times, which is a reasonable and a safer leverage compared to other brokerage houses which offer a very high leverage, which means more risk. So by any means, you do not have to come up with the full value, but only 5% of the value of the contract. Due to the leverage mechanism, if the market goes against you, you need to top up any amount to meet the margin call when you go in deficit. Else, if the margin drops to a low enough level, your positions will be liquidated by the system automatically to avoid overloss. We will explain in details when that will happen in the next slides moving forward. There is also no expiry date for Forex trading. This means you can hold a position as long as you wish, but not without a price. There will be swaps involved when any trade is held overnight, or what we could call the interest. Basically, when you hold a position overnight, which is a consideration that it's past 5 a.m. Singapore time, when you hold positions past the 5 a.m. mark in Singapore time, you need to pay swaps for it. You can totally avoid this by doing intraday trades and closing the position before you go to bed. Right, over here, shown here are the major Forex pairs that traders trade on the Forex market. These are popular among Forex traders. We have the euro dollar, the pound dollar, which are European pairs. These are moderately volatile pairs, and typically as new traders, the volatility is quite attractive. But if you are a new trader and would like a pair that is less volatile, you can trade the Aussie dollar or the dollar yen pair. Recently, dollar yen pair has gone very volatile also, but the direction is more predictable. So as a beginner, it would be recommended that you start with Aussie dollar or dollar yen, but if you are a more risk averse trader, you can actually go for European pairs. Another pair is the dollar Swiss. It's a very volatile pair, and other crosses as well. If you are trading European pairs, you need to follow the economic data and political events happening in the Europe and the UK. As all these pairs are versus the US dollars, you definitely need to follow the monetary policies in the US that will affect currency movements as well. We'll discuss on the actual indicators that you need to look out for. Listed are the margins for the various sizes. So you can take a look at, there are two contract sizes stated here, but there's no limit to what kind of contract that you can go for. You can go for any denominations of 1,000 contract, but for reference purposes, the 10,000 contracts for a euro dollar requires a 553 US dollars margin. And if you want to trade a regular lot size, you can go for $5,530 US margin. Similarly, for other pairs, it lies between the range of $300 to $500+ for 10,000 contract size, which means for micro contract size of 1,000, you only require about $30 over to $50 over per trade in the account in order to start trading a micro lot size. Okay, let's quickly also cover on the mechanics of the Forex calculation when you enter a trade. Shown here is the Aussie dollar, and you can see in the middle right here is the contract size of a mini size contract, which is a 10,000 contract size. This is denoted by 0.1 in the volume on the MetaTrader 5 platform. So as you can see here, we have a very tight pip spread and having a promotion right now for Aussie dollar. There's 0 pip spread. As you can see, is 0.6704 bid versus 0.6704 offer with a fractional pip of 5 fractional pips difference, which is basically almost zero, close to 0 pip spread. So this is very good for traders who wish to do intraday trades, since it's very easy to break even with a very tight spread. Over here is the contract size that we are looking at. So it's 10,000 Aussie dollar contract size, and the margin required for one trade in one mini size contract is 335 US dollars, which is 20 times the average. All right. So the smaller tick movement is the fourth decimal place, 0.0001, which equals to 1 US dollars for a mini size contract. Take for example, if you have a view that the Aussie dollar will appreciate, rise in value, you will buy the $10,000 contract size at 0.6704 as shown as the market price. And subsequently, when the price rises to 0.6714, you can sell off the rate to make a profit or close the position. So you can see the difference between 6704 and 6714 is 10 pips, 10 pips movement. And since 1 pip is equals to $1, 10 pips equals to $10. Pretty simple to calculate, right? So in the account, you'll be left with $335 plus $10, and you will have 345 US dollars in the account. Let's move on to the next trade where the trade goes against you. In this example, I'm looking at the euro dollar pair, and you can see the contract size is now increased to the regular lot size of 1.00, which is $100,000 euro contract size. For this contract, you need a 5% as the margin, so the margin requirement is 5,530 US dollars. As long as you have 5,530 US dollars in the trading account, you can start trading in this lot size of 100,000 regular lot size. But the small tick movement is a bit different here. 0.0001 is now equates to 10 US dollars, as the contract size is magnified 10 times already. In this example, since the margin required is $5,530, we have put in an extra amount of money and top it rounding up to 6,000 US dollars in the account, which is more than enough to start off one trade. So we continue to buy one lot of euro dollar, there's a typo here, 100,000 euro dollar contract at 1.1055 offer price. In this example, we will not close off the position and let the position roll to the next day. So when the next day comes, we will have a settlement price given, and this will be, in this example, the settlement price has actually dropped from the actual entry price of 1.1055. The settlement price shown here is 1.0955, and the difference between the entry price and the settlement price is 0.0100. This is 100 pips difference, and since 1 pip is equal to 10 US dollars, 100 pips difference, sorry about the typo here, is equals to $1,000 loss. This is actually an unrealized loss because you have not closed out the position, but it's mainly based on the mark to market to the settlement price. So in the account, since you started off with 6,000 US dollars, with an unrealized loss of 1,000, you are left with $5,000 in the account. And because you need to maintain a margin of $5,530, this will actually result in the margin call, and the margin call amount is $5,530, which is the margin that requires to be maintained at all times, minus all the funds that you have in account, which is $5,000 after considering the unrealized loss, giving you an amount of a difference of $530. You need to top up this $530, else liquidation will occur if the market goes against you further. So I hope you're following so far about the margin call trigger, and how long before can you hold a position before they will liquidate the position. So the answer to the question, it depends on the market, because this is an auto cut system. So moving on with the same example, the auto cut will happen at 20% mark of the initial margin required. This means that if the market goes against you such that it reaches 20% of the $5,530 required, which is the value of $1,106, all positions will be liquidated. So as long as the market does not reach the value of 1,106 remaining in the account, you can hold the position as long as you want. Yeah. So, but do consider that swaps and everything will accumulate, and over time, if the market takes a further direction against you, there are situations where you can actually reach the 20% margin mark. So when accounts funds reach 1,106, the depletion of funds will mean that you have lost $4,894, and auto cut occurs. Remaining account leaving you with $1,106. Of course, we do not want that to happen. Hence, we do not actually go into too big a position, but relatively manageable position size, so that you have sufficient extra funds to prevent the frequent top-ups and the possibility of reaching a auto cut situation. So this case would mean that it would have dropped 489 pips from the price of 1.1055 and reaches 1.0566 in the exchange rate before the liquidation will happen. Oh, that's a very quick cover of the calculation. If you have any questions about this, we can always get in touch. You can send me a WhatsApp message on the calculation. Yeah. Or you can actually come back to the slides when the YouTube video is placed on YouTube later on. Okay, so we will move on very quickly to the technical aspect of the Forex trading. Right, what we use here is actually the candlesticks chart. So I'll go through briefly for those who are new on what the candlesticks is about. So a candlestick is a very useful tool in the chart. It provides information about the buying and selling strength. So a very quick introduction to what it is. On a candlestick, you will be able to see the support resistance, the historical data on reactions to price levels, which can be used to decide entry and exit levels. It is not an indicator, but it does give hints to the price momentum, price strength at a point in time by using different time frames. This means using 4 hours chart will give hints for the next 4 to 8 hours what will happen, and daily charts would mean it will give hints on the daily movement. You can also gauge what the price bias is, whether buyers are taking control or whether it's on the seller's side in the next 4 hours or daily by using different time frames. This is done because the candlesticks record the movement of the price and display through a pictorial view as shown here, through its shape and size and color. If it is as if saying that it is a quick briefing or update, if you may, of the price movements previously without you having to constantly stay beside the market and watch price movement. However, it takes time to observe and learn from experience what each candlestick movement actually means. And we'll be sharing some of these observations today and how I interpret them and gather certain hints the candlesticks that reveal about the market scenario and the price direction bias. Let us first explain what a candlestick comprises of. Shown here is a candlestick. Let's do a quick recap. You can see there's a body in the middle and there's a wick on the top as well as at the bottom. There are 4 pieces of information they can get by just looking at the picture of a candlestick. This is depicted over here: the open, the high, the low of the candlestick, and the closing price. So for example, let's take a look and assume that this is actually a candlestick taken from a daily time frame chart. Starting from the wicks, from the top end of the wick is the high of the day. So the top of the wick is the high of the day, and at the bottom is the lowest price of the day. The market has reached for the whole day. The body is made out of different colors, so typically a red means a downside, and a green or a blue, it means an upside for the day. Whichever case, you can tell that it's an up candle or down candle just by the picture of it. For example, this red candlestick indicates that the price opens here at the top of the body over here over the day. At some point in time, it has swung to the high and the low, but ultimately at the end of the day, the price closes at the bottom of the body here. Vice versa, the green body will mean the open price is over here. Throughout the day, it would have swung to at high or low or whichever sequence that has happened, and finally will have closed over here. So that's how you read the candlesticks of the chart. It takes a bit of a few tries to get it, but with a few readings of the chart, you'll get it very quickly. So in summary, the candlestick provides you 4 pieces of information: the open, high, low, close, by the wick and the color of the body. That's the basic discussion on it, but importantly, it also shows other information and how it relates to each other with the length of the wicks and the bodies that can actually tell you the strength of the price movement. So with that, I will just go on with a very important candlestick that gives you a good indication of the price momentum. This is the hammer candlestick, and by the name, it looks like a hammer. Many times in volatile markets, a hammer candlestick will often emerge, and this is shown by an extremely long tail in comparison to its body. So take note of the ratio here. It has to be longer than the actual body itself. This is actually a very big obvious candlestick hint on the reversal of the market most of the time. Yeah, but it's not always true, but most of the time. So when it appears, especially on a structural support level and vice versa on the resistance level, as an inverted hammer on the other side where the tail is up. When it does appear, you can be quite confident that this is there will be a substantial move emerge after, giving a good profit to risk ratio. So this is a candlestick that we would like to look out for when looking out for trades. From this candlestick, it is a bit biased to one side of the body and hints that it will head towards one direction as the body is not centered. So which side do you think that the market is biased to when this candlestick approach it has emerged? Give you a few seconds to think about that. So as you look at the long tail is at the bottom of the body, and the body is located on the top side. Just by looking at the shape and size of the candlesticks, you can quickly tell that it's more biased to the upside, meaning to say that you will likely expect the prices to move further upwards because the body is biased to the upside. Without even looking at the open, high, low, close, by looking at the shape of the candlesticks. In this example, let's assume that this is a 4-hourly candlestick, and we'll break it down to explain to you what is the undergoing within this 4 hours by showing you the information for the past 4 hours instead of the whole day in the case of a daily candlestick. This depends on the time frame you're using on the chart. Just a quick one: when you look at multiple time frames to analyze, both in the long term and the short term. All right, for example, this 4-hour candlestick starting from 12 o'clock, let's assume, to 4 o'clock. It is open at the top. So over here is the breakdown. It is open at the top, right? Over here, reaching a high shown by the wick, which is close to the opening price, and a low at the bottom of the wick. It then finally closes at the base of the body. So for the first candlestick over here, it's from 12 to 1 o'clock. The second one is 1 to 2 p.m. The third one is 2 to 3 p.m. and finally to 3 to 4 p.m. candlestick, the last one. Now you know the full story of the movement as shown here. The price opened at 12 o'clock at the top and reached the high shown by the tip of the wick and collapsed quickly in an hour, right to here. The next 3 hours, at 1 o'clock, the next 3 candlesticks show a fight back of buyers in 3 hours, cancelling whatever grounds that the selling has attained and pushing it back close to where it started. As you see, we are doing an analyzing of the buying and the selling here. This is also observing the price momentum, which is a constant analysis of and taking a look at what the buying and selling is actually doing. And from this reaction from of these candlesticks, we will determine which side is the strongest side in the situation. In this example, there's a fierce rejection of the sellers, although the selling was strong, right? And then a fight and a pushback to where it came from. So showing you that the buyers have substantial power here. Right, that was some time taken for the analysis of hammer candlesticks, and this just means that the hammer candlestick is hinting that the buyers are strong at rejecting the sellers. But this does not mean that it just means that it makes a good defense battle against the selling, but no new grounds were gained as they just fought off the sellers. So it's important to observe what happens after this candlestick to see if the buyer can continue to do an offensive attack after the defensive attack against the sellers and advance into higher prices territory. This is the follow-up candlestick that will be the confirmation. Hence, the first condition for the hammer candlestick is always a confirmation with the follow-up candlestick. Let's look at the scenario here for a better understanding. This is actually an Aussie dollar chart, a daily chart. Each candlestick depicts a day. The circle candlestick is the hammer as shown here in the black circle. The confirmation candlestick is the follow-up candlestick showing a push of prices by the buyers, implying higher probability that buyers might win engagement. So you can see here the blue candlestick follows up with a after the hammer candlesticks. Alright, after confirmation, the candlestick which depicts a decisive long body with tails on both sides. This is a slight indecision, but still slightly biased the buyers because it's in the upper territory now. Shows that the sellers try to push back, but the blue candlestick is pushing on, and the sellers could not really push back this movement. So what is so special about this level of price that the sellers failed to push through? Looking back at the historical chart, I would have drawn out the support lines, and you can see that this level over here is a resistance level, a support level, once visited many times, 4 times in fact, 1 time, 2 times, 3 times, right? And 4th time, 2 times over here. So you can see that this is a pretty solid support and resistance, support level, right? So the bounce off here is on a proper support level for the hammer. Now, the next candlestick shown here is actually an inverted hammer over here. So similarly, you will understand from what I said earlier that with the tail on this side, it will propel further downside, right? Yes, this is actually the tail also actually happened at a distinct resistance level. And although it shows that sellers were also very aggressive over here, you will have to have a confirmation on the follow-up candlestick afterwards. And with the follow-up candlestick afterwards, you can see a very solid blue line covering the whole of the tail and even advancing into more upside territory. This has given you a very good hint that the buyers have actually demolished 2 times the sellers tried to push them over here and over here as well, showing that more or less the sellers are actually used up a lot of their power already. This can be shown at this point of time. What actually is a good opportunity for you to enter the market already. The next candlestick shows a try to push back but failed to do so, and another tail emerged over here, and everything else is history after that, and the market takes off. So as you can see, by just comparing the length of by looking at hammer candlesticks and comparing the length of the bodies, you can actually gauge the buying and selling strength through this encounter. So let's move on to the next slide. By observing and comparing the length of the bodies of the candlesticks, it will hint on whether the buyers or the sellers are winning the tug of war. Considering a scenario where the prices are all in a tight range as shown here in this chart, how do you use candlesticks to gauge the price momentum and pick the winning direction? Before we can do that, let's do a market situation analysis of this chart. An example shown here is a dollar-yen daily chart. It was in a long-term uptrend So over here is in the downtrend, and since bounced off the bottom with 3 white soldiers over here denoted by this 3 blue candlesticks over, and this actually happened twice over here. Subsequently, the buyers the battle is on, and buyers and sellers are fighting out in a long battle, as shown here, right? This black box over here in the ranging market, right? So how do you determine who's going to win in this tug of war in this range market over here? So first of all, to sound off, in this kind of scenario when it's ranging, it always starts off with a lot of volatility, where there's a lot of up and down price movements that you can see here, not indecisive. And you can observe the strength of the volatility by the length of the candlestick bodies. At the beginning, on the left-hand side of this range trading, you can see the bodies of the candlesticks are actually longer, right? As you approach the right-hand side of the range trading, it typically tapers off to more smaller length bodies and ultimately become more flat, right? So this when it becomes flat, it will show you that ultimately it's closer to finding a side and one side will prevail. But how do we determine that, right? So referring to this candlesticks on the black box, as you can see, fighting out started of the long bodies, and after the initial taper, the sellers make a move, and you can see that this long selling body coming inwards, emerging. The buyers responded with some blue bodies as well, but they were comparatively shorter than the sellers. So you can see that the bodies of the blue and red getting smaller, and finally this red body emerging, and the blue tried to fight back but was smaller than what actually had over here. And finally, when the sellers make a push and cover the candlesticks with a longer selling body, you can see there was a substantial downside and the direction was chosen. After the next support level, the buyers came back again, and once again it brought the prices back to the same level over here and went into range trading once more, as denoted by the green box. Buying was careful and tested waters a few times, right? So there's a lot of range trading going on. But this eventually ended with a red flat body, as you can see with full bodies over here. Finally, the body become flat, and showing that the red body selling was weak. The sellers were weak. This gave the hint that the buyers can move, they could make a move, and they did. And soon after, the buyers took off outside the range, and there was no stopping them. The sellers didn't want to stop anymore because they have ran out of power. So just by comparing the length of the buying and selling candlesticks, you can determine or give you hints on or make a guess on how the market is going to move on after the range trading. So it's always a comparison in context to the scenario that you're looking at, and not looking at individual candlesticks to determine buying and selling. Next, let's move on. What other things that you can look at is actually the length. This is another example. Previously, we have a range trading. This is an example of a trending market. In this scenario, as the market approaches the resistance at the top over here, you can see it started off with the uptrend with an increase in momentum on the left side, on the left side with a lot of long bodies, and as it approaches, the body becomes shorter, showing a decrease in momentum. So when that happens, you have to be careful that the market is actually slowing down, buying strength is slowing down, so it can go into the next phase, could be consolidation or even a reversal. So it will be not wise for you to enter into a buying at such a stage, so late in the market. All right, so this does not mean that a reversal will definitely happen. It could consolidate and continue to move upwards, right? But buying at this level is not recommended, as this is actually at the end of the phase already. So through in the trending market at the late stage, you can also look at the length of bodies to determine that the market strength is actually slowing down. The other way that we look at is the tails of the candlesticks. So besides, as explained earlier with hammers, by observing the tails, the occurrence of these hammers and inverted hammers at support and resistance levels. In this example of Euro-Dollar daily chart, you can compare the length of the tails to get an idea where the prices are rejected. There will still be a need for confirmation of follow-up candlestick, as the reject at that level does not mean there's enough momentum to cause a win of the engagement. In the circle areas, you can identify the candlestick that has tailed significantly on one side of the candlestick that will cause a higher chance of propelling the movement to the direction where the body is. For example, over here, the tails on this side, the body's on the bottom, it propels it downwards. And this case over here. And over here, tails on both sides, but the side with the longer tail shows more rejection and hence more propelling towards side, giving you hints that probably this side is actually winning with the body. Right, over here as well, you can see that this example here is more undecided. You can see that there's a tail propelling over here, but the ratio of the tail to the body is not balanced, as it is equally balanced, sorry. And you can see there's not much bias from the rejection, and the selling strength is pretty strong. But over here, the strength of rejection is even higher because the ratio of the tail is much longer than the actual body, which is a more proper hammer compared to this, which does not look like a proper, I wouldn't call it a hammer. But so in this case, this will mean that the rejection is stronger in comparison with this, and hence with the candle candlestick, once it covers the tail over here, the market more or less has decided that the selling strength is not able to hold this defense line, and the buyers will take off after that. Right. So by comparing lengths and tails, you are able length of the bodies and the length of the tails, you are able to determine and compare the price and the buying and selling momentum. All right. So over here, let's look at this chart over here. Look at the chart. Would you determine that the price will go up or down? I'll give you 5 seconds to think about it. By using the length of the bodies and the tails that you previously discussed. Okay, so you have got an answer. Let's analyze the situation together. You can see that the price has fallen below this mature rising channel here, denoted by these two lines over here. And this indicates that sellers have overtaken the buyers who previously pushed the price higher. There's now also clearly a noticeable change in trend with the lower highs and the lower lows. So the highs is getting lower and the lows is getting lower here, and a break of the trend line over here. So showing you that the market is oversold and the sellers are rapidly gaining momentum. We can also see that these three candlesticks over here, after they break out, is what we call the three black crows on the candlestick pattern. Basically just three very strong bodies with small tails, right, moving in the downside direction. This pattern is considered one of the most important candlestick patterns, signaling a possible trend reversal and the beginning of a downtrend. Finally, this hammer over here, which is the point where we were discussing, asking you where this will hit on, shows that the home buying is currently unable to push up prices and has been rejected at this support resistance area. Now, just do a quick one that typically we draw support resistance line as one line, but I always say that you have to take an area on critical support resistance level, and this can be determined by taking the multiple levels over here and forming an area. And you can see it's been rejected when the buyers reach this area strongly, showing you that the sellers are coming in. And after a weak push by the buyers and a strong selling confirmation after covering the candlestick, the direction market is down. So giving you a proper comparison between the buyers and sellers. All right, let's take another look at a current chart. All right, these are all previous charts. So this is actually a current chart of dollar yen that's taken last Friday. So how would you determine this market will move after this? I give you another 5 seconds to determine. Okay, you might have answered already. So let's analyze the chart together. Previously, the pair was on an uptrend and has since broken the supporting trend line, which is denoted by this black line that goes through the bottom of this movement, this diagonal line over here. Selling was strong, and it was so strong that it has breached the 200 moving average. This is the moving average and everything, and it's broken below the 200 exponential moving average. It has done two small retracements over here, this and this, but all this has formed a lower high and lower lows, as you can see here, lower high, lower lows over here, right? Very strong downtrend after breaking out the trend line, right? So this pattern over here is a descending triangle on the right hand side. When we were asking currently, is forming a descending triangle pattern, and this is actually a at the bottom of the downtrend, a descending triangle is typically showing that there's a test of this support level and chance that it will break through. Of course, it's not 100%, but probably about 80% of the time. Yeah, but yes, this will show that selling momentum is strong, and there's probably it will be good for a pullback upwards against the trend line that I've drawn again over here before you can enter the market. But overall, the view is that selling momentum is strong and likely to win this engagement, and we shall see if these on the dollar yen chart later on. This what happens this few days. All right. So I've actually covered very quick on how I look at candlesticks patterns, and that's the technical aspect of it. We'll quickly move on to the fundamentals aspect of it, right? So the first up, the fundamental indicator that's quite important nowadays is the inflation indicator or the headline inflation. This is the CPI or the Consumer Price Index, which measures the inflation in the country. In words, it examines the weighted average of prices of basket of consumer goods and services, such as transportation, food, and medical care. And inflation rates have a large impact on the central bank's decision-making process. The Fed has often mentioned this economic indicator in the FOMC statements and how it impacts on the reversal of policy decisions. When inflation gets too high, it's very likely that the central bank will raise interest rates to tame the inflation. And when it's too low, they will lower interest rates. And that's what we are seeing right now with the the Federal Reserve, government. The ideal rate for inflation is ideally 2% in a normal market. For much of the 3 years, inflation ran well above the 2% goal, and labor market conditions were extremely tight. The FOMC committee, or the Federal Open Markets Committee, is what we call the Fed in short. Primary focus has been on bringing down inflation. This is the first economic indicator to look at. After the COVID pandemic in 2020, there has been an imbalance of supply and demand of goods and services. Supply chains were affected by a combination of lost workers and disrupted international trade linkages. Demand also increased as the lockdown situation allowed people to have more savings for the purchases of goods, as they are not able to go out. As a result, inflation spiked in 2021 in the months of March and April. Initially, the common expectation for the Fed is that the supply conditions will slowly improve reasonably quickly once the pandemic is over, and the rapid recovery in demand will also run its own course, and this situation would normally rotate properly back to the goods and services before the lockdown, bringing inflation down by itself on a normal process. However, that was not what happened, and the Fed recognized that they need to do something. So in the later part of 2021, in November, financial conditions began to tighten. The Fed started the tightening policy, phasing out asset purchases. By early 2022, headline inflation has exceeded 6%. Then new supply shocks appeared. Russia invaded Ukraine at the end of by early 2022, and that's led to a sharp increase in energy prices. This improvements in supply conditions and the rotation in demand from goods and services were not enough and taking too long to rotate inflation downwards in a normal cycle. Also, in part, there was further COVID waves in the US, and COVID continued to disrupt production globally. And also extended lockdowns in China kept happening. So FOMC jumped straight into action. They raised the policy rate by 425 basis points in 2022 alone, and another 100 basis points in 2023. This restrictive policy that they adopted finally reached a rate of 5.5%, what we have seen today, which is held since the July meeting in 2023 last year, for over a year now. So the Fed has emphasized on the importance of handling inflation situation firsthand first. Only with the stability in prices can the work of restoration of the labor market as well as the economy be carried out. This was forcefully demonstrated in the commitment in restoring inflation down to their target level of 2% through the rate hikes that we see. This is the bar chart that shows the inflation figures for the past 5 years. You can see that the spike happened in March 2021, over here by these two bar charts over here, then quickly reach a peak of 9.1% in June of 2022. It took the same amount of time, about 14 months, to bring it down to 3.7 months in August of 2024. Sorry, August of 2023, somewhere here. So it declined back to a sustainable level last year. Since a year ago, inflation has been coming down at a much slower rate, reaching 2.9% since July. Or yesterday, we have seen the figure, and it has been 2.5%, a further drop of 0.4%, which is what they wish to have. That is to have the inflation figure to be in the lower range register of the 2% mark, which is between 2 and 2.5%. And this means that the Fed is actually ready for a policy reversal. All right. So this is all in the plan of the Fed Reserve, and has expected this. Of course, they would want it to come down more before they actually adopt a policy change. But inflation is a process that takes some time, and they are confident that this momentum will actually take some time. Will take another month, and it will be reached. The next economic indicator that they look at is the unemployment. After tackling the inflation rate to 2%, the Fed is now looking at the unemployment rate. When the economy is in poor shape and jobs are scarce, the unemployment rate can be expected to rise. When the economy is good and a healthy rate, the jobs are relatively plentiful. Well, the Fed chief, Powell, said that holding interest rates too high for too long would threaten the economic growth and jobs. Fortunately, unemployment rate did not skyrocket, and there's ample room for the Fed to respond to any risk of further weakening labor market conditions. Now, the acceptable rate for unemployment rate is between 4.5 and 5.5%. They were able to handle it. But the current rate is at 4.3% end of July. So it's still well below this range. This means that there's no immediate need for the Fed to address this issue. So they have, hence the statement from Powell that they have ample room for maneuver over here. So how did inflation fall without a sharp rise in unemployment above its estimated natural rate? Pandemic-related distortions to supply and demand, as well as severe shocks to the energy and commodity markets, were important drivers of the high inflation, and their reversal has been a key part of the story of the decline, said Powell. So the unwinding of these factors took much longer than expected, but ultimately it did happen, and it played a large role in the subsequent disinflation. As the pandemic subsided, job markets were moderated as well. The historically high level of vacancies relative to unemployment has normalized primarily through a decline in vacancies without sizable and disruptive layoffs, bringing the labor market to a state where it no longer is a source of inflationary pressures. Let's take a look at the unemployment bar chart over here. This shows that in the pandemic year after COVID-19, in April of 2020, unemployment rate increases to 14.9%. This was mainly transitional, as the pandemic soon subsided and jobs returned to normalcy soon after. However, since May this year, it's slowly climbing above 4%, as shown as 4.3% in July. And Fed is now taking a quick look at unemployment to make sure that it does not go out of range of 4.5 to 5.5%, or any way above it. So there's no problem here with unemployment rate, and inflation is brought down. Hence, the Fed Reserve's plan to actually have a soft landing of the economy. So let's talk about the Federal Open Market Committee, or FOMC meeting. This meeting is conducted 8 times a year, during where the Fed determines monetary policies such as interest rate decisions. Steering the economy out of a recession or crisis, how the market views the decisions is also important on determining the strength of the currency in Forex trading and the economy also. So generally speaking, when an economy is doing well, monetary stimulus is not necessary, and interest rates are high, currency is stronger. So this can be seen from the rally of the US dollar this past 2 years. The dollar yen reached a high of 161.95 in July of 2024 this year. Then, the Bank of Japan made an unexpected rate hike of 25 basis points just a few months ago, causing the rate to dive 2,000 pips in a span of 2 months. It is important to note that any difference in expectations versus the actual figures announced will be the impetus for adverse movements as seen in the unexpected rate hike of the BOJ, Bank of Japan. The minutes of the meeting for the FOMC also hints of more aggressive future rate hikes, as the Fed tries to steer the direction of the currency, even there's no actual movement of interest rate. As the market will factor in all these monetary statements into the price, the monetary policy statements into the price of the exchange rate before the actual announcement itself of the rate hike that is expected. So you can see now that Forex traders should also pay attention to the minutes of the meeting. Let's look at the movement of the figures over here with the since 2019. So in 2019, if you remember, during Trump's time, U.S. and China were in the trade war, and the Fed is concerned that the conflict will bring the economy down and push up unemployment rates. So they had three rate cuts to help the economy. But in the second half of 2019, we know what happened, right? Sorry, it was not 2019. Yeah, 2019 it started happening, but the effects came in 2020. So in the end of 2019, inflation was running well below the central bank's 2% target, so they had it under control. But COVID-19 came, and in the early of 2020, the year after COVID was discovered, the effects started to be felt all across the globe. Public health officials recommend that politicians impose lockdowns to stop the spread of the virus and ease the hospital cases. So roughly 20.5 million jobs was lost in April 2020 alone. The unemployment rate shot up to 14.7% in 2020. Right. So immediately the FOMC delivered two huge rate cuts at unscheduled emergency meetings. At meetings that were not scheduled at all in March of 2020, they returned the Fed rate immediately to 0.25%. Right, immediate cuts in the same month twice. While the economy was technically growing again in May 2020, showing the shortest recession ever happened. So within a span of few months from the fallout of COVID-19, Fed jumped in, and technically they were out of recession already. So what happened was Fed actually introduced more stimulus and had extensive measures to include the provision of up to 300 billion new financing for employers, consumers, and businesses. And they did so through the purchase of treasury securities, mortgage-backed securities, and a massive 700 billion QE, which is a quantitative easy program, to buy treasury bonds in this emergency move. So this sees also that year that US GDP plunged and it plunges by 30%. Right? So for the following year of 2021, you can see the GDP reaches 1.6%. And since then, on April of 9th, the Fed has announced 2.3 trillion stimulus package. So a lot of money was printed to support households and employers of all sizes, and also the further purchases of the government bonds, treasury bonds. So to hold interest rates low, the Fed has been buying 80 billion in treasury bonds and 40 billion in mortgage bonds each month into the December of 2020. For the whole of 2021, come April, they continue to increase the purchases up to 120 billion every month, despite acknowledging a rise in the inflation, because this purchasing requires US dollars, and the continuous printing of money caused the inflation as well. And policymakers noted that indicators of the economic activity and employment have strengthened amidst progress of vaccinations and strong policy support. So they realized inflation figures were starting to climb, and the Fed started to scale back on their bond buying stimulus. And at the end of the 2021, so in November 2021, you can see a cut in 15 billion of bond purchases. That was the beginning of considerations of the phasing out the monetary policies of asset purchases. So in November 2021, Biden took over, and it was already president, and Powell was continually appointed as the Fed chair. So very quickly, This is the last slide for 2022 and 2023. It's easy to forget that the Fed was holding the federal funds rate at zero as recently as the first quarter of 2022. They began buying billions of dollars of bonds every month to stimulate the economy, and this caused a 40-year high inflation, right? So once the Fed decide to do something on inflation, they move very quickly. Over the last 16 months, uh, in order to handle the inflation, the central bank raised Fed funds, as mentioned, by more than 5 percentage points over this 1.5 years. This helped, this had an effect. So you can see the inflation really came down after that. So without price stability, the economy does not work for anyone. And Powell said that in the August 2022 speech at Jackson Hole. In particular, without price stability, they will not achieve any sustained period of strong labor market conditions. So since then, we have left interest rates at 5.25 to 5.5% for the fifth consecutive meeting in March this year, in line with market expectation. But it signals that it will plan 3 rate cuts at the end of the year. That did not happen. And in August, it mentioned that it will only have 1 rate cut for this year. And this was expected to be the September meeting this month. So we'll see what happens. Okay, so that basically covers the rate cuts in, in September. So we will have to see for the next upcoming meeting. And that wraps up the cover on the fundamental aspect of it. We'll take a quick look at the trading platform discussion and what are the tools that you can use for trading on the MT5 platform. So as you can see here, the price code is over here. A very quick one, you can see that you can place a trade by simply double clicking on the menu over here. You can choose whichever contract size you want, so as small as 0.01. You can make an exchange execution, which is a market order straight away, or you can actually use a pending order to key in the price that you want with a buy limit order or sell limit order and enter the price of. In this example, I'll use a market order, and I'll click on probably a sell now, right? And once you click, you can see that the position is shown over here, 1.10164. So as you can see, there's a strong selling momentum over here. So probably there's some near-term short, very short-term 1 hour that there's some downside expecting. So nevertheless, from this you can actually double-click on this stop loss to high profit and set whatever price you want to take. Maybe if you want to do a stop loss, you can do it higher up at 1.11 just 20 just for the demonstration purposes. The take profit will be 1.10 just to enter the trade, and you can modify this. Once you have done it, you see that the values I've entered will be shown over here. So this position is protected by the stop loss and will take profit for you even if you turn off the computer and go to sleep, right? And you can see there's swaps here, column, and overnight trades will have swaps. But if you do an intraday trade like right now, there won't be any swaps. So the figure here you see is actually what you'll get. There's 0 commission charges. So once the figure is blue and you close out the trade, it will be credited into the account, right? So, sorry, I entered the wrong volume here. This is actually a regular lot size contract, so that's why every pip is $10 movement. You can straight away close out the position also by double clicking on the position and choosing this position to close by clicking on this particular position number at this rate. And when I do that, the fund $16 will be credited into the account, and that will be the end of it. All right. I actually wanted to show you this platform also because many people did not know that we have additional tools that you can use about the price momentum and price strength that can help you as well. So this can be downloaded from our website, and you can have access to it even on a demo account. So I encourage you to go take a look at it. So basically, you just have to download and it will install into the platform. And once you open it, it will be shown you under the navigator, and you can double click on it. And when it happens, when you double click on it, this window will pop up and they will give you Forex ideas based on the system's evaluation of the price strength and everything. So over here, you can see for Euro Yen, this is actually a 1 hourly time frame that they are thinking, and they have actually found a pattern here for a double bottom, right? And suggested that you go for a long trade over here and for a target area over here, because this is actually the resistance area over here. So that's why they set it like that. But of course, intermediary, there's a support here, which can be a short-term resistance, which happened over here, you can see. But if it tested and breaks through, likely will go for here. Yeah. So this is a trade where it has analyzed trend patterns and also a breakout and given you a trade to trade. So can be used for consideration and for any trades that you wish to place. To take a look at the chart, you can just click on this, right click on it, on the pair euro yen front window, and you can see that, right? So yeah, the analysis is quite good for you. As you can see, there's a support over here, resistance level over here. The double bottom is over here. It break and it tested this with this support and resistance level. If it breaks, then the likelihood that it will test the next resistance level is over here, right? And this is good one because it has waited for the momentum to actually leave this area over here, and there's a back test over here on the support level. I need to determine that this might not be it's not a false breakout of the upside, but do take note that there's some short-term pushing selling here, so there might be a retest again to the downside. But once it breaks this level, right, over here, the likelihood of it going to the highest next resistance level is there. So you can actually make use of this tool over here to assist, and we also have the other one, the signal center trade ideas that you can use. This also can be also downloaded, but for this, the suggestion of the trades would be limited because only live accounts will have access to the premium trade ideas that we offer. So opening an account is actually free. So I would suggest you can actually open a free account to try out all this indicator. Even though if you're not trading, you do not need to fund immediately, but you can have access to all these trading ideas that's available. And we do have CFDs as well, trade ideas as well. So over here, you can see all these premium ideas given to you that you can look at if you have a live account. This is a demo account that I'm not showing. So basically, this is something that's suggested that's not limited to live accounts. So I'll take a look at it. This is actually a spot goal idea. So what it says here that it will have to buy and the target area is over here. The buy area entry is over here and stop loss is right over here. Okay, so of course we are not far away from the entry level already. Yeah, but previously when the trade triggered, it's supposed to be at this point, I believe. Yeah, so it triggered that trade and it worked out pretty well, I would say. The direction was there. So you can access to the confidence level of the trade was 50%. So you can choose better, higher percentages for considerations if you wish. What I meant to say that these are indicators that is easily available when you open the trading account or even on a demo account. So let's move on back to the slides and continue. So we have actually seen how the amplifier is available on the desktop. We also have it on tablets as well as mobile app, as shown here. You can also place trades on your mobile app on the go when you're outside. So it's a zero commission, so you do not have any cost. What you see is what you get on the prices, but there are spots involved that you need to take off for overnight trades past 5 a.m. Singapore time. Our spreads are very low, and we often have promotions, right, for almost zero spread pairs, and you can enjoy 24-hour trading on this major forex pairs as low as 0.6 pips on the euro dollar, and you get access to all the trading tools that I have mentioned, the trading central tools, right? If you need assistance, I'm actually a servicing AE and I can help you with all this if you sign up for the account with us, right? So just to share with you, we have this system here that I can, if you are signing up a demo account to try, you can also do so. But excuse me. There are some services that provided by myself if you sign up for an account, which is available using the QR code over here. I'll be providing WhatsApp information, WhatsApp economic data updates every week if you sign up account with me. There'll be technical discussions on trades, and I'll be assisting you with any questions pertaining to your account or trading. I cover markets on Forex mainly, global indices as well, precious metals like gold and silver, energy like crude oil and Brent crude. So you'll be executing the trades itself, but you have a second perspective on technical aspects or any opportunities in the market of the trades based on the trades that you do. So besides this, right, the Trading Central is a very good tool that can help you on the technical aspect part if you're not that savvy. As mentioned from my MT5 platform. Besides that, we also send email technical reports to you via email on suggested levels of entry and exit. These are only suggested levels for your consideration, and they cover many pairs, including gold, euro dollar, pound dollar, dollar yen, Aussie dollar, and so forth. So you will have access to the technical aspect of trading as well as daily commentaries that will be emailed to you as well. And we'll in this commentary reports, we'll give you updates on economic news happening around the world. This is a Q update on the latest economic news that might have potential impact on the markets. This saves you the work of reading up or searching it on the internet yourself. Hence, we provide both the fundamental and the technical aspect of trading information to you, and you can have a platform ready to enter the market whenever you are ready. So besides this analyst report, you can also reach out to me on technical views on your trades that you might have, and these are all come without any additional cost at all. So it's absolutely free, and you have no there's a zero commission on the MD5 platform. So currently we're running a promotion for Aussie dollar where the spread is basically zero spread and almost close to zero with a very slow 3 fractional pips or so. And you can take the opportunity to try if you're a beginner on this pair. This is quite a stable pair and rather predictable pair to trade on. Right, so to open an account is very easy. MT5 is commission free. Intraday trades do not incur swaps. If you're interested to get started, open the live trading account with us, with Philip Nova, at no cost. The entry level is low, as you can start trading with just less than $100 for micro lot size, or for mini lot size a few $100s. And the risk exposure is controlled. If you have been thinking of opening an account and trying Forex trading, this is a good time for you to start with this promotion on Aussie dollar. You can get started with the account first and trade live when you're ready. Just get access to the tools and start looking at charts and try out on the platform. There is no admin fee or maintenance fees for the account, and you can get access to all these premium trades and Trading Central ideas and try it out for yourself first. So the process is very easy via SingPass. Just scan this QR code within a minute. You can create an ID, and this account will be tagged to me servicing your account, and we will assisting you if you have any questions pertaining to your account. So by on the page 3 of the submission form, there will be a question where it comes up with how do you know PNPL? Simply put my code over here, ZQW, in the answer and my name, Phil, and I'll be assisting you with your account and also advising on your trades if you require me to do so. And foreigners can also open this account online via this QR code without SingPass. So just scan this QR code to start the opening process. If you have further inquiries, just feel free to drop me a WhatsApp message or email. My contact information will be given at the end. Yeah, well, it's over here for the email address too. So let's see if we have any questions so far. Okay, there was some questions about the recording, but not really. But typically, people will actually ask whether there's any fees required. So as I mentioned, there's no maintenance fee. Account opening is free, and the MT5 has a zero commission platform. So you can actually try out the platform first by opening it and do some paper trading. There's also a demo account link available later on, which you can try out if you wish to do so. And I'll show it to you on this slide here. Yeah. So the demo account is on the left here. If you wish to try out the demo account, you can scan this QR code. Or if you wish to open an account, you can scan the code on the right. So that's about we come to the end of the webinar, and that's all the time we have today. Sorry for the overrun. Just feel free to drop me a message or email if you have any queries. Thank you so much for being a wonderful audience for tonight's webinar. A link to the recording of this webinar will be made available probably by tomorrow. If you have any further queries to the webinar or would just like to get started, a simple reply to the email and I'll get back in touch with you shortly. So that's it. Thank you for joining us again, and this is Phil Gunn signing off. Have a good evening ahead.